Retiring in just 10 years. For most people, that sounds impossible. How can you step away from work in such a short time by putting away just $1,000 a month? That's the kind of question that sparks late-night debates and gets people scrolling through financial calculators hoping for a magic answer. But here's the truth. It's not about finding a magic formula. It's about understanding how money actually grows, how hidden forces like inflation and taxes chip away at your progress, and how to set up a plan that doesn't just look good on paper but actually works in real life. And I encourage you to remain engaged until the conclusion, as this video focuses on practical and attainable goals. It's essential to provide you with a well-defined plan, highlighting the common pitfalls that many encounter, and guiding you through actionable strategies that can transform $1,000 a month into a solid basis for achieving financial independence. By the conclusion, you will have a clear understanding of what can be achieved, and what cannot, over a 10-year period. Let's begin with the calculations, as figures provide an objective perspective. By contributing $1,000 each month over a span of 10 years, and assuming an average annual return of approximately 7%, your total accumulation would be around $173,000. Should the markets perform favorably and you achieve an average return of approximately 10% annually, your total could increase to about $200,000. That amount is quite significant. However, it's essential to recognize that those figures are nominal. It's important to consider that in a decade, the cost of living is expected to increase compared to current levels. Inflation plays a significant role here. It subtly diminishes the actual value of each dollar you set aside. With an annual inflation rate of 3%, a sum of $200,000 in 10 years will have the purchasing power equivalent to approximately $150,000 today. If inflation trends higher, approaching 4 or 5% as observed in recent fluctuations, the disparity will widen significantly. That's why many individuals find themselves caught off guard. Individuals may observe a six-figure balance in their investment account and feel a sense of wealth. However, when they attempt to rely on those funds for their living expenses, they often discover that the amount does not provide the financial flexibility they anticipated. Make sure to subscribe to our channel and also press the like button to know more financial insights. Consider evaluating your personal expenditures. Consider a scenario where your monthly rent is currently set at $1,000. In a decade, assuming a modest annual appreciation of 3%, that apartment may be valued at approximately $1,350. The physical attributes of the property remain constant. The square footage and the walls do not alter, but the impact on your finances is unmistakable. It's important to consider all expenses, not just rent. Essential expenses such as groceries, healthcare, utilities, and transportation tend to increase gradually over time. Therefore, if your strategy does not adjust for inflation, you may be losing ground, even as your savings total increases. This leads us to the initial essential strategy: contribution creep. Many individuals tend to set their contributions at a static amount of $1,000 and fail to make necessary adjustments over time. As prices increase, it's essential for your savings to grow as well. By raising your monthly contribution by a modest 3% annually, you are effectively maintaining your financial position in relation to inflation. In the first year, an investment of $1,000 grows to $1,030 in the second year, and approximately $1,060 by the third year, continuing to increase thereafter. By the 10th year, your contributions would be approaching $1,350 each month. Initially, this may seem like a challenge, but the truth is that many incomes tend to increase over time. Typically, salary increases are driven by factors such as raises, promotions, and adjustments for inflation. If your earnings are increasing while your contributions remain unchanged, you are effectively saving a diminishing percentage of your income annually. By incrementally increasing your savings, you ensure that your effort remains consistent in real terms, and over a decade, that minor change can significantly enhance your overall portfolio by tens of thousands of dollars. However, even if you successfully manage contribution creep, there's another subtle challenge to consider: tax drag. Annually, your portfolio yields dividends and capital appreciation. If you maintain these assets in a taxable brokerage account, a portion of your gains will be allocated to taxes. Over a decade, that portion accumulates significantly. While your portfolio may show a nominal return of 7%, the actual growth after taxes could realistically be closer to 5% or 6%. The difference may seem minimal at first glance, but over a 10-year period, it can significantly reduce your final balance by tens of thousands. What are the potential solutions? Strategic account selection. Tax-advantaged accounts such as a Roth IRA or Roth 401k can significantly impact your financial strategy. When you utilize a Roth account, you make contributions using after-tax income, allowing your investments to grow without incurring taxes in the future. Moreover, during retirement, your withdrawals will be exempt from taxes as well. That indicates the $200,000 reflected on your statement is indeed $200,000 available for your use, not $200,000 less a significant tax obligation. Consider a comparison between two investors. Each individual should consider setting aside $1,000 monthly over a period of 10 years. One utilizes a standard taxable account, whereas the other employs a Roth IRA. With comparable investments, the Roth investor has the potential to accumulate tens of thousands more, as their returns remain intact without being diminished by annual taxes. It's not merely about increasing risk, it's about selecting the appropriate vehicle for your investments. Now, let's discuss the investment opportunities available. It is often recommended to allocate your funds into diversified stock market index funds. That truly represents a strong basis for future growth. However, if your objective is to consider retiring or semi-retiring in a decade, it's essential to focus not only on growth but also on generating income. That's where real estate investment trusts, commonly known as REITs, become relevant. In contrast to purchasing a rental property, which involves managing tenants, handling maintenance issues, and making substantial down payments, investing in REITs provides a way to engage with real estate via the stock market. It is mandated that the majority of REITs allocate a minimum of 90% of their taxable income towards dividend distributions. This indicates that as your investment appreciates over time, you will also benefit from consistent income payments, funds that can be used to manage expenses, reinvested for further growth, or serve as a reminder that your capital is actively generating returns. Imagine allocating $1,000 each month into a REIT-focused ETF over a span of 10 years. By reinvesting dividends and considering average market performance, you could potentially grow your portfolio to a value between $220,000 and $250,000. With an average yield of 6%, you can expect to receive approximately $1,100 to $1,250 in monthly dividends. Those figures represent tangible income that can help you manage your expenses. In contrast to bonds, which tend to decline in value during periods of rising inflation, Real estate investment trusts often see advantages as property owners generally increase rental rates in response to higher prices. The focus should not be on whether $1,000 a month can fully support your retirement in a decade. The key consideration is whether that $1,000 can serve as the initial investment that expands into a significantly larger sum. Indeed, the answer is a resounding yes, provided you take inflation into account, adjust your contributions accordingly, utilize tax-advantaged accounts, and concentrate on investments that offer both growth and income. Now, watch the video appearing on the right side to know the hidden signs that show you're on path to becoming a millionaire. Also, subscribe to our channel to help us complete our goal of 11,000 subscribers.